Welcome once again, everybody, and thanks for joining us for today's webinar. We're really happy to have the folks from Diamond Hill back with us. Before we turn it over to them, however, I need to share my screen and do a quick thank you. First of all, a thank you to Brian Fontanella, the portfolio specialist from Diamond Hill, and his colleague Matt Lehner, who's going to help us today, and especially when we get into Q&A later on. Housekeeping, we'll use the chat function in Zoom for posing questions, and that way Brian and Matt will be able to see them come in and do their best to get you the answer you seek. So the only other thing I want to do, actually the only other folks I want to thank at this point are our annual sponsors, the folks, the firms you see on the screen here. They are generous every year with their time, talent, and treasure to bring us great thought leadership, great professional learning opportunities like today. And we simply could not do what we do on your behalf without their help. So thank you to RBC, DGI, Nuveen, Securian. You can see the names on the screen, and again, we really appreciate their support of the society every year. So I am going to stop sharing my screen and kick this over to Matt Lehner to get us started. Thanks, Matt.
Absolutely, Mark, and thank you for that very kind introduction. Hopefully I'm coming through okay. But definitely, great to be with the chapter here again, and this time, of course, with Brian Fontanella from the equity side of our house to discuss growth versus value investing. Which, gosh, considering the week that we've started, we couldn't have planned this any better. But before I turn it over to him, I did want to take just a quick second to introduce the group to Diamond Hill and share a few comments about really what makes us tick. So, for those of you that haven't covered us in the past, we're a smaller boutique firm that was founded in 2000, really based off of two principles that still govern us today. The first is specializing solely in intrinsic value investing. So this is that same Benjamin Graham approach that focuses on a company's cash flow to determine its worth or its ability to repay debt. And the second is a complete and total alignment of interest with clients. A couple of examples are here, setting clear expectations of what we're aiming to achieve inside each strategy. So this includes having a stated peer ranking and return goals for all of the portfolios. We also, and I think most notably, have a significant personal investment inside the strategies that we manage right alongside your clients. To put a number next to it, because I think that's worth doing, is through the end of third quarter, we've invested over 125 million of our own dollars inside the 12 strategies that we manage. So all of this leads for us to build a high conviction, benchmark agnostic, and capacity aware portfolios with an objective of adding value for clients. So without further ado, I want to turn it over to Brian Fontanella, equity specialist here at Diamond Hill, who will share his perspective on the markets and the forces that have led the growth versus value debate to rage on. As Mark said, Brian is going to be taking questions at the end of his prepared marks, which really should be about the 12:30 time mark. But in the meantime, feel free to submit your questions via that chat function, and we'll be sure to get to them just here in a little bit. So with that, take it away, Brian.
Okay, great. I assume you can hear me okay?
Coming through great.
Okay, awesome. Well, thanks, Matt. Thanks to all of you for joining us. We really appreciate your time today. As Matt had said, I'm going to talk about just some of our observations on the market this year, in particular, this dramatic outperformance of growth stocks over value stocks. I'll talk a little bit about the magnitude of outperformance and maybe some different and hopefully interesting ways to look at that. I'll talk briefly on why this might be occurring, and also a little bit on how the economy and just business investment in general are making it tougher to really distinguish between what is a growth stock or a value stock in the first place. So that's what I want to touch on. I thought we could start with a quick poll and have a little bit of fun here. So hopefully this works. I've not tried the polling function here yet, but it seems pretty straightforward. So let's get going with that. So I've got 3 questions here that I'm hoping you all will respond to kind of get a gauge of everybody's thoughts on where we are in this growth versus value debate. So the first question over the next 5 years, which will outperform the Russell 1000 Growth Index or the Russell 1000 Value Index? All right, we're at 28. It seems to be 29, slowing down. We have 16 votes for the Russell 1000 Value, 13 for the Russell 1000 Growth. So a slight edge for value. Okay, how do I get to the next one here? The next question. Oh, I got it. Okay. Which market cap level will Apple hit first? It's currently right around plus or minus 2 trillion, 1.5 trillion or 2.5 trillion. Okay, I'll give it just one more second here. All right. Also fairly evenly split, 15 votes for 2.5 trillion, 13 for 1.5 trillion. All right, third and final question here. Facebook, Amazon, Apple, Microsoft, and Alphabet currently represent about 23% of the S&P 500. In 2025, so 5 years from now, will they account for more than 23% of the S&P 500 or less than 23%? All right, one more second here. Okay, this one's really interesting. 20 votes for, or 74% of the votes for less than 23% of the S&P 500, and 7% or about a quarter of the votes for more than 23%. So only a quarter of you think those 5 stocks, the FANGs, will outperform over the next 5 years. Okay, that's all I had for the poll. Thank you for indulging me on that. I will go ahead and share my screen here. We've got some slides to go through. Okay, Matt, maybe if you could just confirm you can see my slides, okay? All right, great. So these were our poll questions. All right, I'm just going to quickly start with a couple comments on equity market performance this year. Through yesterday, I think markets were up right around 11% year to date. By the way, this slide is slightly stale. This is through September. Everything else, I think, pretty much is through October. But if you were to just not at all pay attention to markets for the first 10 plus months of the year, and I were to tell you that the markets were up 11% year to date, you would think that's a pretty normal year. But I think we all know that it has been anything but a normal year. And I think one of the interesting things to look at is this very wide dispersion in performance between the sectors and businesses that have done very well this year and the ones that have lagged. So on the far right, you can see energy, by far the worst performing sector, down around 50%. Demand has fallen off a cliff, although it started to come back a little bit. There was too much supply already coming into this year, but given where demand is at, there's way too much supply. If you remember earlier this year, you had the OPEC and Saudi Arabia and Russia skirmish. So you combine that with a lot of debt for many of these companies, and it's kind of been a perfect storm for the energy sector. Financials also among the worst performers this year, down around 20%. We all know interest rates have been incredibly low. The yield curve is relatively flat. There's uncertainty about credit losses for banks. There had been some uncertainty around business interruption claims for insurers. So not a great environment either for financials. On the other side of the chart, you see information technology, consumer discretionary, communication services to a lesser extent, but those handily outperforming everything else. This is as you have surmised or know, mega cap tech. And in a lot of ways, these businesses have been not only hurt by the coronavirus, but in this pandemic, but benefited from it. And you have Apple and Microsoft, they represent about 45% of the tech sector. Facebook and Google are about a similar percentage, 45 or so percent of communication services. Amazon alone accounts for a quarter of consumer discretionary. So you have all these stocks, these mega cap tech stocks that have done incredibly well. So they're really what's driving not only this sector performance that you're seeing, but also overall market performance as well. And again, things have changed a little bit in the past day or so, but really this observation and the performance differential between these mega cap growth stocks specifically, but really anything growthy more broadly, has been very unique this year. And I don't need to really remind anybody of that. I think you all know that, but I do think this is a case of a picture being worth 1,000 words. So again, I've got some charts here that kind of go through some of this and illustrate how impactful it's been. This slide here is just looking at the spread between growth and value. So it's the Russell 1000 growth minus the Russell 1000 value each year for the past 40 years. And through October, and again, this has kind of narrowed a little bit in the past few days, but growth was up 20%, value was down 13%. So that's a 33 percentage point spread. Maybe 5-6 weeks ago, that had been over 40 percentage points. If you look back, a lot of people are comparing this to the tech bubble. If you look back, then you had somewhere in the mid-20s percentage points of outperformance for growth at the peak of the tech bubble. You had 29 percentage points of outperformance for value in the year 2000 after it burst. So comparing today to those sorts of numbers, it's certainly well above that. So we wanted to dig a little bit deeper and see if there were some common themes among the stocks that have been performing best this year. One of the things that's very noticeable, obviously, is that the fastest growing of the growth stocks are dramatically outperforming. So what we're looking at here is the Russell 1000, with each of the stocks ranked highest to lowest based on their long-term earnings growth profile, and then grouped into quintiles. So the quintile on the left, the highest quintile, Q1, is the fastest growing 200 stocks in the Russell 1000. And by the way, that's probably the top half or so of the Russell 1000 growth. Through October, those businesses were up 30% year to date. The slowest growing 200 stocks were down 12%. So mega cap tech has been a big factor in all this, but really anything with growth has outperformed, and the faster your growth, the better you've done. We're looking here at a similar slide based on size, so market cap. And similarly, you can see that the larger the stock this year, the better the performance has been. Again, we did the same thing here, ranked stocks highest to lowest by market cap and grouped them into quintiles. The largest quintile of stocks was up 6% through October. The smallest quintile was down 17%. So we're seeing a similar effect and very wide performance spread based on size. And then this is the last of my quintile charts here, but probably the most interesting, at least in my opinion. We're looking at, again, the same thing, but the stocks are being grouped by PE ratio. So the most expensive stocks through October were up 26%, and the least expensive stocks were down 23%. So that's about a 50 percentage point spread, which is just really unfathomable. Those are differentials you only see every 2 or 3 decades. It's very rare. So this really is a market when you combine these three observations where the largest, fastest growing, most expensive stocks are dramatically outperforming. And again, they're kind of related. Mega cap tech is really driving a lot of this. And that's what we're going to look at on this slide here. At this point, this was in kind of the polling question. We have the 5 largest stocks in the market contributing a higher percentage of the overall market than they ever have been. The 5 stocks, Facebook, Amazon, Apple, Microsoft, and Alphabet, again, are 23% of the market at this point. In the peak of the tech bubble, it was right around 18%. So we're well above that now. And then if you look at the bottom chart, it just kind of gives you an idea of how these stocks are affecting the broader market. So through October, those 5 stocks were up 39% year to date. And if you took them out, the market wouldn't be up 3% at that point in time. It would have been down 5%. And the median stock in the S&P 500 was down 6%. So this is a really dramatic effect on the broader market for just 5 stocks. So again, the point here, this is just a very, very unusual environment. And this is also looking at the valuation of those top 5 stocks. Historically, the largest 5 stocks in the index, the PE of those businesses, has roughly tracked the overall market. But there's been a very big divergence in the past 5 years. The 5 largest stocks trading well into the 30 times earnings sort of range, whereas everything else in the S&P 500 is trading around 18 times. It's not as big of a differential as the tech bubble, but still very noticeably wide. And then I show this slide as well. I just think it's kind of interesting. Again, it's the 5 I've been talking about, and it's showing that they're currently 23% of the S&P 500, and you can see how their collective weight has grown over time. But you also see the 18% represented by Microsoft, Cisco, GE, Exxon, and Intel in the year 2000, and what those stocks have done since. And by the way, that includes Microsoft, which has been a fantastic stock in the past 5 or so years. And I'd show it just because I think it's interesting, and it's a reminder that reversion to the mean is a thing. And I'm not saying that something similar is going to happen with these 5 stocks, or if or when or to what extent that's going to happen. I just think it's kind of an interesting reminder. Sometimes you get so caught up in certain businesses and performance and that sort of thing. It's hard to imagine these so dominant companies falling, but people thought the same thing back in 2000 as well. And then I also wanted to show this one. It's again, those same 5 stocks, which is the green line. They currently represent 39% of the Russell 1000 growth index. You can kind of ignore the greenish and yellowish lines for this slide. But I pointed out because I'm not sure how widely appreciated it is that the style indices can become very undiversified at times. And your definition of undiversified, may differ than mine or somebody else's, but I think it's safe to say that they're certainly approaching that now. If you go back to 2007, financials, it wasn't 5 stocks, it was a whole sector, but the financial sector was 40% of the Russell 1000 value index. So again, just a good reminder that the style indices can become pretty concentrated. So again, I think we all know that growth's dominance has not just been a 2020 phenomenon. It's been going on for much longer than that, although the past few years, certainly this year, has been the most extreme, but it's really been going on for close to a dozen years at this point. So with this slide, we're just zooming out a little bit. It's looking at the trailing 10-year Russell 1000 growth performance minus Russell 1000 value. And again, this number has come in a little bit. This one's through September as well. But at that point in time, growth had outperformed value by over 700 basis points annualized for the past 10 years. That's what that slide is showing. That's, again, above tech bubble type levels. And that last chart was looking at returns, which is obviously driven by both earnings and changes in valuation. We created this slide. It just sort of attempts to isolate changes in valuation. And the way to think about it is kind of a ratio of ratios. It's we took the 20% most expensive stocks, the price to book of those, divided by the price to book multiple of the least expensive 20% of stocks. And you can see that over time, the most expensive stocks were 4 to 5 times, trading at 4 to 5 times as high of a price to book multiple as the least expensive stocks. And we've totally blown that out at this point, close to 12 times, much more expensive than at any point in history. So after giving you all a little bit of the backdrop here, what's driving this? And nobody really knows. I mean, there's not a definitive or right answer on this, but I do think there's a few factors that have certainly contributed to it. I think low rates are certainly a factor. We've all heard this duration argument. The long duration stocks, like the big growth stocks, have benefited much more from a low rate environment than slower growth value stocks. I think the modest economic growth that we've seen coming out of the financial crisis over the past 10 years is another factor. I think we've only cracked 3% real GDP growth for a couple quarters in the past 10 years. So when growth is scarce, people are going to pay up for it wherever they can find it. I think that's contributed to this performance differential as well. I think another factor that's maybe a little bit overlooked at times is just how good the fundamentals are for a lot of these mega cap growth companies. These are fantastic businesses. They really don't need any capital to grow. Earnings have consistently been growing 15, 20+%. They generate tons of cash. They've got very deep competitive advantages, fantastic balance sheets. So I just think that's underappreciated a little bit in terms of why we've seen this performance differential and how much earnings growth has contributed to that. It's not just multiple expansion. I think certainly multiples have expanded a lot. That's what this chart is showing, especially this year. But the fundamentals too are very, very good for a lot of these bigger tech businesses. And it kind of gets to a question that we've been getting and thinking a little bit about, which is just how is this environment today compared to the tech bubble? And I think they're similar in the fact that growth has obviously massively outperformed in both periods. And in both periods, a handful of stocks have really had a huge impact on market returns. But in many respects, it's very different as well. If you look from 1994 to 2000, earnings growth for value stocks was actually about 400 basis points higher annualized than for growth stocks. So value stocks grew earnings around 14% compounded versus just under 10% for growth stocks. But we all know that growth stocks have massively outperformed in that time period because their multiples expanded so dramatically. So that was truly a time period driven by speculation. And that's much less so today. That's some of it, but less than it had been 20 years ago. We've had similar outperformance for growth stocks, but their earnings growth has been much better too. So over the past 6 or 7 years, earnings growth for growth stocks has been about 500 basis points faster than for value stocks. So 6.5% or so versus less than 2% earnings growth for value stocks. So better fundamentals is a pretty notable driver of this performance difference between growth and value as well. And if you're looking for kind of a shorthand to explain why the growth indices have done so much better, I think it's helpful to just look at some sector exposures within those indices. So up top, I'm just looking at three of the spiders, three sectors. Technology is the green line, financials is the tealish line, and then energy is the gold sort of line. And it's their performance relative to the S&P 500 over the past 12 years. I don't really need a chart to show you for this one, but obviously tech has vastly outperformed. Financials and energy have dramatically underperformed. And down bottom, you can see the average weighting of those three sectors in each of the Russell 1000 growth, Russell 1000 value, and Russell 1000. That's their average weight over the past 12 years. So kind of a simple way to think about why growth has done so well and value hasn't is that tech is a huge portion of the growth index and it's done extremely well. And it's a pretty small portion of the Russell 1000 value index. And vice versa for financials and energy. They've been terrible performers, but they're a huge portion of the value index and a small portion of the growth index. And I think why these sectors have performed the way they have kind of ties back to some of the contributors I mentioned a minute ago. But this really is a pretty easy to understand picture of what's going on here. And I think kind of the last section of what I have, a different aspect of all this to consider is really the relevance of historical measures of value in the first place. And historically, value stocks were classified that way because they traded at a low price to book multiple typically, or maybe PE multiple. So for example, Russell constructs their value index based on price to book multiples. So the lowest price to book multiple stocks, I mean, this is an oversimplification, but essentially constitute the Russell 1000 value index, for example. But today you've got so many businesses that are creating a ton of value through intangible assets that don't show up on the balance sheet. So they're not included in book value. So for a lot of these businesses, we'd argue that book value is just much less relevant today. So I just got a headline here. This was a Bloomberg article from a few weeks ago that talks a little bit about this. Others have been writing about it for a little while now. We've written a little bit about it as well. But just to kind of go through an example, take Facebook. Facebook pays their engineers to create products like Facebook and Instagram. And when they pay their people, that compensation gets expensed through the income statement. But they create assets like the Facebook platform that generate a ton of value going forward, but those assets are nowhere to be found on the balance sheet. So if they're not included in assets, they're not included in book value. Remember, book value is essentially just assets minus liabilities. So then you just ask, how relevant is a metric like book value for Facebook anyway? The shares today are trading right around 7 times book value, which is certainly too high to be included in value indices. But just kind of think about, what are those intangible assets worth? They're clearly worth a lot. So what if we could take the value of those and add them to the balance sheet? Assets on the balance sheet would be higher, book value would be higher. So Facebook's price to book multiple would be much lower. And maybe it would even be low enough statistically to be considered a value stock. We don't know, but the point is that there's a lot of businesses like this today where book value just isn't a great indicator of value. And you can sort of see that in this chart. It's basically looking at the rate at which businesses are investing into tangible assets, which is your green line, that has been declining as a percentage of, just kind of think of GDP over time, and businesses' investment into intangible assets, which is the black line, which is clearly becoming a much bigger portion of investment. So again, there's been a huge shift toward intangible asset investment, which makes, again, thinking of historical measures of value like book value a little bit more difficult these days. And to that point, this increased investment into intangible assets is clearly affecting where the value of businesses is coming from. So this is a chart from Ocean Tomo, they're a merchant bank focusing on intellectual capital based in Chicago. And it's showing that in 1975, if you took the market value of the S&P 500, 83% of that was represented by tangible assets on the balance sheet. So those are, again, factories, equipment, vehicles, inventory, those sorts of things. This year, that has declined to just 10%. So again, it illustrates how much more important intangible assets are as a source of value today. And again, when they're not accounted for on the balance sheet, which a lot of times they're not, again, makes it much harder to use price to book as a measure of value. And just to give you a couple more examples, there's tons of them out there today, like Facebook. We own a company called Booking Holdings. If you don't know the Booking name, that's basically Priceline, the online travel agency. They've created these network effects that are incredibly valuable, but they're not included on their balance sheet anywhere. But it's a hugely valuable asset because they have a huge supply of hotel rooms. So customers want to book through Priceline, and customers are booking through Priceline. So hotel owners want to list their rooms on Priceline. So again, a very valuable network effect built on technology. That's not accounted for on the balance sheet anywhere. You think about customer acquisition costs. So if you spend $20 today to acquire a customer, whether that's through marketing or promotions, et cetera, and you know that on average, that customer will pay you $20 a year for the next 5 years. Well, today, all you see is earnings that are lower by $20. It looks like that's destroying value. But in reality, you've acquired a customer whose value well exceeds that $20, but none of that is captured in a ratio like price to book multiple. And again, just more broadly, you think about the shift toward a service economy where you don't need a factory anymore to produce goods or assets, your intellectual capital. So these shifts have become much, much more prominent in the past, certainly several years, but even decade plus. And now I've said all that. There are definitely still some areas where book value is still very relevant. So balance sheet businesses, for example, like financials, book value is very relevant. Home builders, where a lot of the value is in the land, book value is still very relevant. But for a larger and larger percentage of the economy and thus the stock markets, it's just not nearly as relevant as it used to be. And it kind of gets back to our intrinsic value philosophy that Matt touched on at the outset. We're not just looking for stocks with low price to book multiples or PE multiples. We're estimating the cash flows of a business over the next 5 years and discounting that cash flow stream back to today to come up with an estimate of intrinsic value for that business. So when you think about that exercise, projecting cash flows 5 years out into the future, growth is a very important part of that exercise. To us, growth is a component of value, and that philosophy has at times allowed us to find value in quote unquote growth companies like a Facebook or a Google or a Microsoft. And that's because we can take into account these things and these changes in the broader economy and the strength of their franchises and levels and durability of their growth, their network effects, all those sorts of things. I would say, to be clear, we are very valuation sensitive and don't love these businesses at any price. We have been trimming them over the past couple months as they have really skyrocketed in price. But what we're not saying is Google trades at 25 times earnings. That's too high a multiple for us, and we'll move on to something else. That's, I think, how historically a lot of value investors have thought about value, but that's just probably not enough today. And our CIO, Austin Hawley, recently wrote a piece on this called Value Investing Evolved. I think that was the title of this session here today, where he talks about some of these things. So that's about all I had. If you are interested, I'd encourage you to have a look at that. That's out on our website. And I will stop there. And I think we're going to open it up for some questions.
Hey, Brian, thank you. And just as a reminder, if you do have questions, be sure to type those into the chat function here, and we'll be sure to address those here with the remaining time. I guess while everybody is working up those questions, you had shared a slide a little bit earlier that talked about the trailing 10-year performance of growth outperforming value, and I think that came in most recently at about 7% annually. Over those 10 years, we have seen glimpses, short-term glimpses of value making a comeback in there, and even over the past 48 hours, we've been fortunate to see that as well. Can you talk about those metrics or those things that you think that you look at that could lead us to think that, well, gosh, value is going to have a little bit more of a pronounced and prolonged outperformance versus growth?
Yeah, I mean, it's the $1 million question, right? I would start by saying that we are not trying to call when this reversal in value and growth will happen or predict it or position our portfolios around some belief as to when that's going to happen. But what I would say is that it kind of goes back to some of the things that have been driving growth's outperformance, where the opposite sort of environment, I think, would be a very good one for value. And that's one where we get a little bit more economic growth. We get a little bit of inflation, interest rates tick back up a little bit, and you've got maybe a little bit steeper of a yield curve, which would certainly help the financials. I think that type of environment would be good for value stocks, and we've even seen a little bit of that recently over the past 5-6 weeks. I think in October, the 10-year jumped about 17 basis points to 85 or so basis points, and then yesterday on the big value day, it jumped pretty notably. Well, I think that's a little bit of confirmation that, more of that would be good for value. But again, it's a relatively short time period. As you alluded to, we've had these fits and starts this year for value outperforming again. But I think if we were to start to see those sorts of things play out on a more sustained basis, that's probably a pretty good environment for value.
I'll put you on the spot here, just in terms of the inflation numbers. Is there a bogey that you're looking for, that the market is looking for, where you think that it would convince more investors that this rotation is really going to hold?
Well, the short answer is no. And if there is one, we don't know what it is. What I would say is that it's higher than where we are today, which is sub 2%. But inflation too high of inflation is a big concern for us and something we're really watching out for. I think more inflation is fine. The Fed's certainly going to do what they feel like needs to be done to get there, it seems like. But if you start cracking 4 or 5% inflation on a sustained basis, weird stuff starts to happen, and that's probably not as good environment for value. So it's not that any sort of inflation is good for value. It may or may not be. We don't know. But it's probably going to be the case if you get too much that that may or may not hold. But certainly a little bit more inflation than we have today, and the effect it has on a little bit higher interest rates, again, for the financials specifically, but also other areas of the market, would probably be a good thing for value.
Mm-hmm. So we do have a couple of questions that have come in. One question is, has value worked in low interest rate environments historically?
That's actually a really interesting question, because you can look at Japan for the past 20 years or Europe for, however long it's been, 10 plus years at this point, and rates have been very, very low there, and value has still not done particularly well. So it's difficult to say. Yeah, I don't know.
Or the type of value, and I know you went on to describe at least what our sense of value is, but there's a myriad of other definitions of value that have been written about extensively. So perhaps that's something we can follow up with you on.
Yeah, we've not looked too much into different kinds of value. There's obviously different flavors of value investing. Ours is we focus on what we do, which is different than I think what most people think of as value investing, which is buying cheap stuff. That's not really what we do. We've not looked into performance over different periods for different types of value. When I talk about value in this sort of context, it's really about the indices, which is more of a factor-based characterization of value. Because again, as I alluded to, most of the style indices, most notably the Russell style indices, I think those are the most prevalent for the value characterization. They look at book value, but there are other flavors of value that may have done better over time.
I've got a question that was emailed to me, and it talks about banks, and it indicates banks have been an overweight for a while, or perhaps a focus for a while. Is that a bet on interest rates?
It's not. It's very explicitly not a bet on rates. It really comes down to valuation relative to pretty good fundamentals coming into this year. We've been overweight financials more broadly and have had at different times pretty significant weights to banks in particular. But our thesis has been valuation is so compelling relative to fundamentals that you don't need higher rates for those stocks to work. It is certainly our belief that higher rates would benefit them, but the prices we're paying, you don't need that. You really just need kind of consistent fundamental performance. In a lot of cases, capital return is so significant. That's a good chunk of your return right there. If you can get buyback and dividends collectively right off the bat, giving you high single digit type returns, that's a pretty good starting point. So what will be bad for banks is if U.S. rates go negative. That's certainly probably not a good scenario for them. But rates are so low at this point. They're so well understood. They're definitely having an impact on the fundamentals of banks. But again, the question is, how much is that priced into the stocks at current prices? And we think they're very much discounted at current levels.
Mm-hmm. We've got another one that just came in. Is it fair to say that growth is scarce because rates are low?
I mean, yeah, I think that's part of it. All this stuff is sort of intertwined. Rates are low, growth is low, so growth is scarce. So when you have these mega cap tech companies growing revenue 10, 20+% and earnings at a slightly faster clip in most cases, you can pay a higher multiple than the broader market and still earn good returns in a lot of cases. So I do think, at least to some extent, all these things are sort of related.
Mm-hmm. Excellent. Well, I will give everybody one more opportunity to type in a question here or email it to me. But before turning it back over to Mark, if we don't have any more questions, Brian, I do want you to answer your first question. Over the next 5 years, which will outperform, the Russell 1000 growth or the Russell 1000 value?
I mean, I think my answer is definitely going to be the Russell 1000 value, but I would have answered the same way 5 years ago, and that would have been very wrong. I hope I'm not wrong this time around.
Understand. Well, I think that's going to conclude the question. Actually, just one more here. Anything we should monitor that would point towards rising interest rates?
I mean, I think inflation's the big one. If you start to see that, I think there's still plenty of slack in the economy in the near term that you're not going to see meaningful amounts of inflation this month or next quarter. So look at wages and wage inflation, and to the extent that that is pushing up overall inflation, because there have been historically points in time where the Fed has said they want to be very accommodative and keep rates low, but the inflation picture has developed such that they've sort of been forced to raise rates. So I think inflation, in our opinion, is the one thing there that we're probably focused most on.
Okay. Very helpful. Well, I believe that's going to conclude the question and answers. But I certainly appreciate, Brian, all of your prepared comments, and then taking some time here to run through some questions from the audience. Certainly helpful and timely, just considering what's going on. So with that, certainly want to thank the audience and the society for having us again. Hopefully, we'll be able to get some more time on the books, and perhaps even in 2021, live and in person, be able to pick up many of these conversations, either from the equity side of the equation or from the corporate bond side or investment grade space. I know that we've talked about before in previous virtual meetings. So with that, I will turn it back over to Mark.
And thank you, Matt, and thank you, Brian. It appears that we have a lot of shy Minnesotans on the webinar today. It could be that we're all in a state of shock at the freezing rain that came through this morning, and the prospect of 7 inches that we're going to send your way, guys. So anyway, last call for questions. I know I pinged a couple of you privately, and you're still continuing to be shy. So we'll do a quick, just a short countdown here, but this is a chance to dig in a little deeper, guys.
Please don't be offended by the polo shirt here in Columbus, Ohio. We're still enjoying our last 70+ degree day of the year before we get, no doubt, your weather.
Yeah, you're enjoying the weather we had this past weekend when I was outside in shorts putting up Christmas lights. It was a great time. So, all right, folks are still shy. The other possible explanation for that, though, is that Brian, you covered it all and you nailed everything. So everybody's dry on questions today. So with that,
that's the case, but if so, that's great.
All right, with that, we will again thank you, Brian. Thank you, Matt. Thank you, sponsors, and thank you all for joining us today. We'll catch you on an upcoming webinar. Take care.
Thanks, everyone.